Benger with us. Steve, are you there?
I am John. I am. The honor is all mine.
Oh man, good to hear your voice again,
I know.
folks. Steve is I would call him a market wizard. He's in Chicago. He's a big guy in the Board of Trade, and has actually run a pretty big clearing operation. And I love to talk to Steve about the markets because you get a very good macro view every time I talk to him, and I'd love to bounce things off of you to see if they're valid or not, Steve.
Sure. But before we even start, John, and I
Okay,
hate to correct you because you're usually dead on, right? But
go ahead.
my exchange days are long over. You realize that, right? Because we've known each other for 20 years. You should
Right.
know that.
Well, you're still in the loop down there in Chicago, and I would
All
consider
right.
that still
Okay.
being involved, if you will.
All right. That's okay.
Uh, um, I tell you what, what's on your mind? Because we were talking about something pretty interesting earlier, and this Brexit thing is not over with, and all the kind of fallout from it, and we were talking about also how this relates to some of the yield plays going on, and I'd love to hear some thoughts on that for everybody to listen again.
Yeah, I mean, obviously Brexit was kind of like an earthquake, which didn't last very long, and the markets seem to have recovered very well on the equity side of the market, that is. But what has become pretty apparent is there's a huge discrepancy as to how the debt market handles the whole situation and how
Right.
the equity markets handle the whole situation. And once people start looking at that, it's actually rather astonishing what's happening and how those two markets are really detaching itself from each other. They're usually in lockstep, but right now there's a huge non-correlation going on.
Yeah, I was talking earlier about the 10-year, and a decade ago, I remember, I mean, Jimmy Rogers, and there's so many people that, oh God, this is going to end terribly, and the bonds and notes are already too high, and this thing has just continued to march north forever, it seems like, and even up here, I've kind of submitted to it. And it relates to some of the things you just said to some degree, but it's just okay. It's not backing off. The market kind of gives you these indications that it's okay to continue to buy it every once in a while. And I mean, in previous years, I'd be like, "What am I doing? This thing's already kind of blown a gasket." But do you think it can? Do you think these notes and bonds, I guess, can go higher? Is my question.
Well, and that's really the $1 million question, right? I mean,
Right,
where are they going? So,
right.
I think in order to answer that, it really pays to kind of look at what is happening in the world. I mean, Japan, as being the second largest economy in the world, or third largest, but really the second largest in terms of capital markets which are accessible, has negative interest rates throughout. So any non-US investor, any non-domestic, from a Japanese perspective, investor, is really not going to put money into Japanese bonds anymore. Not that they ever have in the first place, but that's a different story altogether.
Right.
The German bond market is now solidly negative too, which is the third or fourth largest economy in the world. So money flows to where there is yield. And right now, among the well-developed capital markets, clearly the US market is the only one which still offers some yield in its government papers. And that, I think, is the reason why we are seeing continued influx into the treasury market, which really suppresses our interest rates. But what really needs to be understood and be talked about for your viewers, I think, is that
Hmm.
the entire yield curve we have is compressing. Like earlier this year, the yield curve, or the spread of the 10-year treasury over the 3 months bills, was about 210, 214 basis points. We are now down to about 110, 114 basis points. It really depends on the day. So without really anything happening in the stock market, because the market by and large has pretty much gone sideways,
Right.
the yield curve has compressed for that period by 100 basis points, which is huge. So the question is, why does the yield curve change so much without really anything big happening in the stock market? And that really leads us to the theory that potentially the debt markets are pricing in a recession. And if that were to be the case, then we will be looking at a major revaluation in US stocks. And that is a big disconnect we're having right now.
Right. Okay. So, but how much of that yield curve flattening in the U.S. is maybe not possibly not exactly, indexed to what you just said as far as, predicting, possible reevaluation, all that, and just basically being kind of arbed into, a lot of the other. I mean, I know you talked about Japan and a couple other places, but how much do you think it coincides with a global kind of recession, or is, what is the connection between the U.S. rates and some of the things going on overseas, as far as like being able to kind of, this yield to continue to go down, that may not be completely, indexed towards the U.S. economy, if you know what I mean.
Yeah, I think I do.
Okay, I didn't explain that at all very well, but I think you get what I'm saying.
Well, I mean, let me rephrase what I think you are trying to say, if that's okay with you.
I'm good at confusing people. Go ahead.
Not me, though. So, I think that there's a significant reason related to the inverted yield curve or negative yields in Japan and in Germany, which drives money into the US debt market. So a good portion of why we are that low in the yields is attributable towards those two markets and a general decline in interest rates across the world. But one has to look as to why that is happening in the first place. The reason why Japan is negative is because there is no economic growth, right? I mean, that economy doesn't grow, regardless of what they're trying to do.
And it probably won't.
Yes.
No matter what.
Yeah. So German bonds are negative because there's a safe bet within Europe, and Europe doesn't really grow either. So we have recessionary tendencies fairly well established in Europe. On top of that, we now have a Brexit, which will, at least if you believe the analysts, will almost certainly prompt a recession in the United Kingdom. So the likelihood of recession or non-existing economic growth is what is driving or force-feeding money into the bond markets.
Steve, I hear the music. Can you stay on for one more segment, or at least part of it? Do you have time?
Yeah.
Great. I'd love to continue this. Awesome. Guys, come back to see us. We'll be right back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to the Gold Report, an $85 value, visit the front page of tfnn.com today.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited-time, 5-year, market-safe currency comeback CD. This indexed and U.S. dollar-denominated CD offers 100% principal protection and is based on the equally rated performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan, filling in today. And we're continuing a discussion with Steve Benger, a friend of mine out of Chicago, down in the loop there. Steve, can you continue, sir?
Yes, I'm still here. All
Great.
right.
Because when you talk, it's much better than when I talk. So let's keep you talking.
No, well, I mean, everything I said earlier is actually supposed to lead to that one point which I would like to make. So the yield curve, no matter what the reason is, has flattened to a point which the last time we've seen that level was in August 2008. And we all know what happened subsequent or right around August 2008 and throughout the remainder of 2008. We had very material losses in the stock market and huge gyrations. So
I barely remember that, but go ahead.
yeah, we all do, right? I mean, because we all would like to forget.
It's burned in my brain, but go ahead.
Yeah, we would like to forget that whole thing.
Exactly. Yeah.
Right. But the point to that whole thing is that we have created a scenario, no matter why, which is eerily similar to 2008, at least on the debt market. And in the same context, the stock market is bumping up against all-time highs, at least in the United States. So if we truly hit a recession, there's a long way to go down. I mean, I call that scenario or that setup a widowmaker.
Gotcha. You still there?
I am.
Okay. Yeah. Well, and again, the thing we were talking about before, I wanted to see if you could answer the question that I was kind of stumbling through, trying to ask before, which was, if all these things weren't going on in the world, all things considered, if there wasn't that arb trade going on with the other kind of rate structures, do you have any idea what do you think rates would be in this country based on, the cooked books of all our economic figures, blah, blah, blah?
I think rates would be about 1% higher, give or take it.
I think that's probably a fair assessment.
Yeah, I think that the Fed fund rate would have to be around 100 basis points, 125 basis points, somewhere in there. But that doesn't explain why long-term interest rates are basically closing in on 1%. Right, that's the rate which really indicates and flashes recession probability.
I agree. Listen, I'm showing the British pound right now, Steve, and we're down to 130 approximately right now. This is a 30-year low on a relative scale. Mm-hmm. Is that what the latest benchmark kind of statement is out there, as far as where this thing has come down to? Yeah. Do you think this thing? I mean, Where's this one headed? I'm sorry to put you on the spot.
Well, yeah, I don't think it's heading up. I mean, that's I don't think it's heading up. So
Right.
obviously, a lot of the decline has been made, but I don't see a reason why it couldn't work itself down to like 125 or so. But it's not heading up, that's for sure. As I mentioned earlier in your show, there's no consensus among the analyst community that the UK will hit a recession within the next 3 months. And given that scenario, that currency is going to crater. I mean, it has already cratered, but it's not going to go up.
When is the? Do you know when the projected like they get control of kind of more? I mean, are they going to try to speed up this 2-year process that this kind of transitional period, or aren't they already lobbying for that to kind of go ahead and get it over with as soon as possible, and then that would also possibly cause the pound even more problems because then they'd have kind of full control to do what they I'm not going to say they're going to pull a China, but really kind of so-called fix things.
Well, I mean, typically speaking, political events move at a glacial speed, right? I mean, nothing
Right.
ever happens within weeks in that industry. So the next prime minister of the Conservatives is not even going to be elected, the way I understand it now, before September at the earliest. So we have a good 2 months before the next government is even in a position to make decisions. So I would be shocked if they get the Article 50 filing done before the end of next year. So I think we have at least another 12 months, potentially more, of wait and see. And that whole wait and see situation is not going to be good for the British economy.
I hear you. Let me ask you another one that I follow this one kind of religiously now. The euro. Is this thing apt to just come apart at the seams also? I mean, the next, the Italian kind of talk is going on. I mean, there's all kinds of rumbling. How, what's the forecast in your opinion on this one?
It's actually very interesting.
It's holding up relatively well in all this stuff, but go ahead.
Yes, it is. So the weekend after Britain voted for its exit, there was an election in Spain, which turned out to be much more favorable towards the parties more closely aligned to the European Union than it was originally expected. And some more recent opinion polls seem to indicate that some of those countries which were notoriously known for being anti-EU are coming around a little bit because they really don't like the consequences which Britain seems to be suffering. So the reason why the euro is or has remained fairly strong is really because of that. I mean, in the beginning, everybody was afraid that British accent is going to make a break of the European Union much more likely. But now there's a belief, at least in some areas, that a British accent will teach everybody else a lesson and it's going to make the Union a little bit more stable. And that is what you see in the currency markets right now.
Well, I am looking at I mean, you can look at this a lot of different ways, and that's a great viewpoint on it, in my opinion. But man, I mean, you could look at this as, wow, it's in the face of all this. There's kind of, not a bad little bit in it, and usually, those types of things usually like, wow. Everybody's thinking the same thing I'm thinking, and all of a sudden they just kind of run it up in you on the north side,
Yes, I mean, it certainly is not the demise some people were hoping for, if you look at it this way, right? It's not completely falling apart. You have this huge downward move one day, and then it bounced back. It's been working itself back up.
Right.
So it really has been a one-day affair for the euro currency unit, whereas for the British pound, it's vastly different if you compare the charts.
Without question. Now, this one kind of weirds me out too. The yen trade, the U.S. dollar yen trade. I'm showing this right now. 101. That general neighborhood's a big area for support on this thing in my book. But do you think this thing gets below par against the dollar? And for God knows what reason. What's your thoughts on this one?
Well, I mean,
we got a little music coming in. We got to take a break. Can you stay on at least to answer that question, and then I'll let you go.
Okay, perfect. Yes.
Okay, cool.
Yes,
All right.
sounds good.
We're coming right back, guys.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage or call our office directly at 877-518-9190. There's a limited supply, so act now. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Tom O'Brien.
Hi, guys. Welcome back to the Tom O'Brien Show. I'm John Logan, filling in for Tom today. We've got Steve Benger we're talking to about quite a few topics. I'm just running you through the mill here, Steve.
That's right.
The last big question, and I won't keep you much longer because I know you got to run, but the Japanese yen, where's this thing headed? Because I thought, around 101 or so we were going to bottom out here, but it looks like it doesn't really want to stay away from that area, and we may head lower. What's your thoughts on this one?
Well, I mean, just for comparison's sake, why don't you put up a chart for the 10-year Treasury? And I think that pretty much might give you the answer. If you follow the theory that a flight to quality and safety is pushing up U.S. Treasury yield prices, then you pretty much have the same situation in the yen. A flight for quality, a flight into safety, perceived safety, is what pushes up the yen.
Yeah, I'm just wondering how safe the Japanese. Yeah, I mean, it doesn't make a lot of sense, but it doesn't have to, I guess. But go ahead.
I know, right? But I mean, honestly, I mean, you really have to look at it on a relative basis. The devil you know is better than the devil you don't know, right? I mean,
I hear you.
And you can't put every egg you have in one basket. So when you sit in Europe, where are you going to put your money? You can put into the US dollar, but it's not that we look like rock stars either all the time.
How about gold?
Well, some of that money is going into gold. There's no question about it. I mean, talk about silver. I mean, I don't know if you have looked at silver.
Oh my God, yeah. I actually thought my chart was wrong when I woke up this morning. I was looking at it on the show this morning, and I said, "Well, that can't be a real print at 21. What happened?"
Well, I mean, I think it's basically a bubble, right? I mean, bubble in terms of like people trying to find things to invest in. And the problem is there are not many well-developed capital markets who can absorb comfortably a large amount of money. So when people try to reach for silver, which really is a small market, that whole thing blew up big time. I mean, look at that move.
Incredible.
Right.
Incredible. Well, you know what all this is, doing to the housing market in the U.S. right now. I mean, I sold a house I had in Raleigh, North Carolina, back 2010 maybe, and just a regular house, nothing crazy special. It's doubled. That the value of it is now doubled, and the real estate situation in the U.S. I mean, these rates, just force people to go out, and I mean they're not getting super crazy with the loans again, but they've got some innovative new strategies out there. I was kind of looking at the investment rental type mousetraps that they have out there now to don't check your background, just put I think it's 15% down, and you're in business if you've declared it a rental property. What do you think's going on with that market now?
Well, I mean, if you really look at what's going on in the world, everything within the context we talked about during the show, where are you going to put your money? I mean, where are you going to put your money? And real estate all of a sudden at a solid 4, 5, 6% looks pretty damn good.
Well, how does that not cause? I mean, where does the inflation pop up? I mean, it's somewhat popping up in that market, but then you've got rates continuing to go lower. I mean, when does the rubber band get stretched out so far that, or does it? I mean, do the rich just? I mean, do the people who have money to kind of the powder dry to continue to do I mean, how does this? Where does this end? I'm getting fatalistic here.
No, I mean you're absolutely right. I mean, ultimately, we have set a cycle in motion, which can only be stopped by a catastrophic event at this point, right? Because we have this easy money coming to the system all the time. Money is so easily available, and there's a scarcity of decent assets to invest in. So the assets which are investable tend to get invested more and more, and people are prepared to accept less and less yield. So the only thing which might potentially change it is an external event. That's how I look at it.
I think you're right. Well, look, thanks for coming on today. It's been everyone's pleasure, I hope.
It was my honor, John, as always.
Yeah, thanks again, and we will pick it up later, I'm sure.
All right, great. Thank you, John.
Thanks very much. Guys.